Hey guys, David Robinson here. Welcome to the apartment investing journey. As usual, another great guest for you today. I've got Bill Ham with me. Bill, how you doing today? Appreciate you coming
I'm
on.
doing well. How are you?
I'm doing great. I'm doing great. Well, look, Bill is a two-time best-selling Amazon author. His first 402 units were closed with creative financing, and he's helped hundreds of other students become successful in multifamily. So I'm really excited to dive into Bill's journey, as well as what he's doing to help others achieve what he's done in his investing career. And so, Bill, our podcast is all about the journey. We'd love it if you'd be willing to back up and talk to us a little bit about the backstory and how you got into multifamily and what your business looks like today.
Yeah, absolutely. I am a pilot by trade. So I've been in real estate for 16 years now. I was a corporate pilot, sort of out of school, out of college, started flying for a doctor, realized that job was very fun flying the airplane. What most people don't realize about a pilot is that's about 10% of the job. The other 90% sitting around waiting to be told when and where to fly and what time and how long. And that's when I realized, okay, hold on. The important people are actually in the back of the airplane. Like the pilot's real important from like takeoff and landing, and then not so important on the ground anymore. So, just kind of realized that wasn't what I thought it was. And at the same time, kind of came to the realization that I was a really bad employee and that I'd probably make for a better entrepreneur. So I started kind of looking into that a little more. Fast forward, I studied for about a year. Real estate, didn't close anything, just read, studied, took courses, whatever I could do. Closed my very first deal, which was a duplex, and that was in 2005. And I got seller financing on that from a friend of mine, and then just kind of rinse and repeated that model over and over from there. Again, as you said, my first 402 units were all with some form of creative financing, but that also included some larger properties, a 108 unit and 152 unit apartment complex. So yes, I started small, but I incrementally worked my way up, and that's how I got here today. And now syndicate real estate, do larger assets. We'll use creative financing when available, but traditional financing is usually what I use now, Fannie, Freddie, stuff like that. So yeah, that's where we're at.
Love it. Well, I appreciate that, really brief synopsis, and we want to dive into some of the details around that.
Sure.
And I think your story will resonate with a lot of our listeners because we have a wide range of listeners, from those that are buying small multifamily property for their own personal portfolio, as well as those active investors in large syndications and passive investors in syndications. So I think your story will hit on all of those. But let's start when you bought that first property. I know we're taking you way back to 2005 here, but you spent a year sort of learning and trying to figure out the space. And what was it that caused you to go to a duplex as your first property? If you remember back then, what was going through your mind? What was that process like for you?
Yeah, that was just actually a bit of luck, because it was two friends of mine that were already in real estate, that were out there flipping, and actually some of the motivation for me to wind up quitting my job, because I was looking around thinking, well, these are friends of mine, they're idiots like me. We were all at the bar last night, we were all doing the same stuff. Wait a minute. I got up and went to work, and they got up and flipped a house or two. Something's wrong with this picture, And so luckily, those two friends gave me my first deal, which was the duplex. At the same time, they gave me seller financing. So it wasn't that I really set out and said, I need to do a duplex instead of a house or something like that. It was more of an opportunity. And it was a financial opportunity, or financing opportunity. Let me say that, because in the beginning, I had no money, no experience, no credibility, no credit, nothing. And so I really couldn't just walk into a bank, sit down, put down 20% and get a mortgage. I mean, the story's great. I did 402 units without, using a lender. Yeah, it's because I couldn't. So I didn't have any money. I was broke. I couldn't, you know what I mean? I was like so many other people getting started in real estate. It really wasn't like a big choice. It was a survival technique of using, creative financing. Later on, I came to figure out that's actually a pretty good method for doing business. But in the beginning, that's how I got started, because I had no choice. I had no money and nothing. So that first duplex was really just about those two friends that gave me my start in business and gave me financing.
Well, and I'm curious, when you started, researching real estate back then, was creative financing an emphasis, or was it this was so okay, I love this. So this
Not
was
at
you
all.
going into this deal. Do you remember how did they present the creative financing, the seller financing option to you? Or did you say, hey, how can we make this deal work? How did that break down?
That one. Yeah, me going to them going, hey, how can I help solve our problem here? You want to sell a property at a premium price, and I don't have any money. Let's figure this one out. But no, and funny thing is that back then, I mean, certainly I did not invent creative financing. I didn't invent seller financing or a lease option or things of that nature. But there was no real material in that. And even to this day, until I started writing, I've got 2 books now, as you mentioned, but until I started writing some of this material, hasn't been a great single source of creative financing. And back, 16 years ago, there was no source. As a matter of fact, I had no clue what I was doing. I didn't know a lease option was actually called that until much later on. I thought I had made that up. I didn't. And, seller financing, all this stuff, there was no real education on any of that. And so I was just out figuring it out. I thought, let me back up and say, I was embarrassed to talk about seller financing. I was embarrassed to talk about a lease option because in my mind, like every normal person has plenty of money and great credit and all the money down they need, and here I am over here getting seller financing and lease options. In my mind, this was some sort of poor person's way of doing real estate, because everybody else just gets a loan, Here, I'm this little nobody over here getting seller financing and all these creative things and I was embarrassed to talk about it because I thought everybody else was doing it, a completely different way. And I had several hundred deals before I ever even admitted how I was getting into the business. And I was at a conference once, a seminar, and somebody really cornered me and was like, no, you got to tell me how you got that deal done. And finally, I was like, okay, fine. Let me tell you what, I got seller financing. I did this. And all of a sudden I look up and I'm just surrounded by people listening and taking notes. And that was my aha moment when I went, oh, you all want to actually know how this works. And everybody was like, yeah, of course. I had no idea. I was so embarrassed to talk about that stuff. I thought, everybody else is rich and I'm poor. That's not true. 16 years later, I realized that's completely not true. Most people start off in the position I was in, and that's why it was such an attractive conversation. I just didn't know.
Yeah, love that. So fast forward a little bit, you accumulated 402 units.
A lot more than that now, but that was the first part.
Right. But up to that point, through seller financing, tell us a little bit about, acquiring commercial multifamily, because it's one thing for, I think there's a lot of, there's more content out there about acquiring residential property, whether that be single family residential, duplex, fourplex, with creative financing strategies than there is commercial. But you alluded to the fact that you at least bought 2 properties, larger commercial multifamily properties, with creative financing as well. Shed some light on that aspect of things.
Yeah, those 2 properties specifically, one was a 108 unit master lease option, and the other was a 152 unit with seller financing. So that's kind of the baseline to that. But so there are differences and there aren't. So the main differences really don't lie within the creative financing. The creative structure, a lease option, seller financing, creating value with an offer, solving problems. These are not specific to commercial real estate. Those apply to any type of real estate. And so the material that I have out there really is technically applicable to any kind of real estate. I personally focus and teach from a perspective of multifamily and commercial. But the differences, again, are really more about the real estate, not the financing, because the seller financing, it doesn't matter what it is. It can be a house, 1,000 units, same thing. The main thing that I would want everyone listening to take away is that no matter what size property you're looking at or you're trying to accomplish, be a problem solver. The creative financing is about figuring out what motivates that seller and what is their issue and how can you create an offer that solves everybody's problem. Whatever issue they have, plus your ability to get into the deal. That's what you're after. And again, that has nothing to do with, it really doesn't even have anything to do with real estate, if we want to be real clear. Creativity and creative financing is done in all genres of business. So it really has nothing to do with any type of real estate whatsoever. But if you're interested in commercial real estate, that is a completely different, separate conversation. And yeah, there's a lot of differences between houses and apartments, but the financing is actually not really one of them.
Yeah. Well, and just to give us some context, you got started back in 2005. You were a corporate pilot back then. At what point in time did you make a full transition from your corporate pilot career to real estate full time?
When I bought that duplex.
Oh, really? So that was it.
That's it. Yeah, I guess the longer version of that story, I had saved up $10,000. So the 10 grand was all I had, to my name, and the duplex was producing about $300 a month in net positive cash flow. That's if nothing broke. I had 10 grand and $300 a month cash flow, and that is what I turned in the 2-week notice on, and thought, I'm just going to figure it out. I said, at the time I was probably more arrogant than I should have been, and I thought, I'm a genius, I'll figure this out. Well, figured out that was not true. Real quick, figured that not smarter than the average bear, but I was willing to work. I was willing to put in the effort and to get the dirt under my nails, and to get out there and to get dirty and figure out how to create a business. And I did that. And that's what I share those techniques now. But yeah, it was a brick by brick scenario. It was not any sort of overnight success thing or anything like that. It was many years of just kind of, going through the ditches of real estate. But yeah, started with the duplex. That was it.
Okay. Love
just
it.
Made the decision to quit and did it.
So you started with that duplex, and then you acquired, at least 100 or 402 units with creative financing. And then you mentioned that you've also been involved in large commercial multifamily syndication. Talk to us about that sort of transition, or maybe just sort of the progression. I don't even know if it's a progression. Okay. Maybe it's a choice, but just talk to us about what that looked like for you from a step-by-step basis.
Right. And that's a great question, because a lot of people think that you kind of go from like a duplex to 200 units, and that is absolutely not true, or at least it was not true for me. It could be for other people, but it was not for me. It was a few years, 3-4 years of houses. Single family, it just started with a duplex, but there were a lot of single family houses, a couple of quads, all that to me pretty much is still in the realm of single family. It's not really larger commercial. The first one that I consider sort of multifamily, real multifamily, was 9 units. So again, not a very big property. The next one past that was 20 units, and then 27 units, and then 44 units. And so it was an incremental process of moving up the food chain there. So I didn't go from 2 to 100 overnight. Once the first syndicated deal was in 2012, and that was 2011, end of 2011. Actually, as a matter of fact, I just sold that property about 3 weeks ago. Owned it since 2011 until about 3 weeks. Just sold it.
That's great.
But we started off, my partner and I started off with seller financing on that deal, but we also syndicated. So we had the lender or the seller carry back 80% loan to value. So they gave us an 80% mortgage, just like a bank. We still put down, my partner and I still put down 20% down payment, but we syndicated the 20%. So we did a full syndication using the private placement memorandum and all.
Really? This is 2011. This is before there's been a lot of education and clear regulation about how to structure these deals, right?
Correct. So we hired an attorney, and they put the paperwork together, but it was a combination of seller financing and commercial syndication. And so that was the first one. Then from there on, I started pretty much getting more into the strict syndication model. And that's going out, finding a deal, analyzing it, saying, yeah, that works. That will produce enough revenue for partners. Break it up, structure it, then going out and networking and raising the money from limited partners, investors. And that's the short answer of how I got there. And that is largely all I do now, is larger syndication deals going forward. But yeah, that's how I got here.
And let me ask why move to exclusively syndication? Obviously, you had a great thing going. You acquired 402 units over a course of a decade roughly. Talk to us a little bit about why that move into large commercial multifamily syndication.
Yeah, the short answer is market cycle. So it's not like I woke up and said, okay, I'll never do creative financing again. I'm only doing syndications. It wasn't like that. It was really about opportunity. And so what we find, and this is also sort of the answer as to why I wrote the book Creative Cash about a year ago. The answer is market cycles. And so markets rise and fall. It usually takes about 10 years, sort of top to top or bottom to bottom. And so coming out of that '08 recession, there wasn't a lot of lending. There wasn't a lot of things going on. Real estate wasn't that popular. So that's where I was forced to use a lot of creative financing because these assets were distressed and lenders' traditional financing really wasn't available for those assets. Well, fast forward, to 2010, 11, 15, 17, 18, the market's red hot now. And therefore, in a super hot market, creative financing works less. Mm-hmm. And so as the market got hotter and hotter and prices were rising, we've come out of the '08 recession, the economy's recovered, real estate's recovered, the opportunities for creative financing started to fall away. And that is indicative of the market cycle. So the more opportunities a seller has to exit a deal, the more ways they have in which to solve their problems, the less likely they are to do creative financing, right? So if a seller can just take that property and throw it on the market and get a full price offer and sell it, that's largely what they're going to do. Why bother with financing and this, that, and the other if they can just get full price? It's when the market shifts and goes into a decline, which is indicated by lenders tightening up their lending process, that's when certain assets become difficult to finance. Distressed assets, something with maybe poor occupancy, something with a lot of deferred maintenance, maybe the plumbing's old, maybe the roof's old, these kinds of things. Traditional lenders really start tightening the screws on those kind of assets. That's not something we've seen over the last 5 years. As a matter of fact, quite the opposite. There's money everywhere, lending everywhere. Yeah, but that comes to an end. And when that starts to cool off due to rising interest rates, anybody read a paper? What's coming in 2022? We know some Fed rates are coming. Right. So as the interest rates start to go up and returns start to decline, those distressed assets start to get kind of unattractive for using traditional financing. And I know market cycles, and I've been watching the market. And so I'm predicting that we're going to go into not an '08 crash, but a cooling off over the next 2-3 years. And that is going to bring a lot of opportunity for creative financing back to the market where it has not been. And that's kind of why a lot of people say, well, gosh, I tried a lease option a couple of years ago. I tried seller financing. It doesn't work. You're right. In really white hot real estate markets, it doesn't work so well, but it works great when people have problems and they're about to. Some of the big things I think we're looking at coming up, tremendous amount of what's called maturity exposure. A lot of people have gone out and gotten short-term interest-only loans over the last few years, and those loans are going to come due. And if those loans come due in 2022 and the interest rates have gone up, that's going to make exiting that property a little more difficult for that seller. And there are going to be some distressed sellers. That's where creative financing is going to come in. And that's why I kind of brought the book out when I did. And I believe it's going to be very valuable information over the next 2 to 4 years. And then again, it'll cool off.
Yeah,
but that's kind of a long-winded answer of why I went from
that's great. Into syndication. So what do you guys focus on from a syndication standpoint? What kind of product are you guys looking for?
Yeah, ideally, newer assets, more of a core market. So I'm running into the burning building, not out of the burning building. So my philosophy right now is newer product in core markets, and not to chase yield into affordable housing and not to chase yield out into secondary and tertiary markets. I see a lot of people doing that. They're saying, hey, if I go out here, on Main and Main, I'm not really seeing any cash flow. But if I go out here to Country and Country Road, all of a sudden I can start to get cash flow because those prices are a lot cheaper. I think functionally that can work and it cannot work depending on the buyer, depending on the strategy. But for me, my group and my team, we're going more back into the core markets, looking for newer assets at the trade-off of cash flow. So in this model, we're working more at equity and appreciation than cash flow.
Yeah. And what's the thought process around that? Why is that? Why are you pursuing equity and cash flow over equity and appreciation versus cash flow?
Lots of answers there, and could turn into a really long conversation. first comment, I don't really think cash flow is that big of a deal. I think it's overrated. I think it's something that we use largely as a sales pitch to get people interested in real estate, to get people thinking about quitting their job, living on passive revenue, all these kinds of things. But I don't really think that's a very viable concept in reality. You are not going to get rich on cash flow. Nobody's ever gotten wealthy on cash flow. Find somebody. It's always about the exit strategy. It's always about getting out of that deal profitably that makes real wealth. And so I have created a concept. It's in my second book that I call a conveyor belt theory of real estate. And we could spend about an hour talking about this, but just sort of imagine a conveyor belt. And the idea is you're going to put properties on this conveyor belt, and that's like a business model. So as your properties are moving along this conveyor belt, that's your hold window. That means you're holding and you're operating those properties, and hopefully you're cash flowing in that model. But as the property comes off the back of the conveyor belt, that's a liquidity event. That's either a refinance, a sale, some sort of realization of equity, right? And if anybody here is listening, stop and think about a property you've ever owned. And what I always ask people is like, hey, can you think of a house or some kind of property? You bought it, you cash flowed it, you sold it. They go, yeah, I can think of that. And I say, okay, so how much did you buy it for? How much did you sell it for? And how much did you cash flow each month? And what people will tell you is, oh yeah, I bought it, and we bought it for $100,000, and it cash flowed $300 a month. It was great. We owned it for 3 years, and then we sold it for $200,000. Great. So for 3 years, you made $36,000 in cash flow and $100,000 in equity. You don't need a calculator to figure that one out. I'm telling you, it's not an argument of cash flow versus appreciation. That's a big conversation I see people get into all the time. Oh, appreciation is a nice to have. We got to have cash flow. No, cash flow is a nice to have. I'm worried about no. You got to have both. Cash flow keeps the lights on. Cash flow keeps the business going. It feeds your investors, it keeps the wheels greased. But as a syndicator, none of us are getting rich on cash flow, especially not if we're using investor money. Most of the cash flow is going to investors. We get paid on that liquidity event. And so the idea is to stack your portfolio as deep as you can, to put as many properties on that conveyor belt as you can, so that in about a 5-year window, you're buying and selling. You're selling one every year, you're buying one every year, you're selling and buying. And if you can hit a liquidity event once or twice a year, believe me, cash flow is not your concern anymore, because you're making real money on the exit strategies. And that's something I don't think a lot of people talk about. And it's something that we have to understand in real estate. Nobody's getting rich on cash flow. That's a sales pitch. That's guru nonsense. You gotta have cash flow, but you're gonna make your money on that equity and on the exit strategy. And so that's why we're super focused on newer buildings right now, because I believe the affordable housing space is going to have a large devaluation. That we're going to see affordable housing kind of fall in its value, but that the B's and the A's, the newer assets, are going to appreciate tremendously. Nothing's cash flow at the moment. Nothing's cash flowing right now. You go find a B, an A, a C, they're all pretty much not cash flowing that much. And so the spread between an A cap rate and a C cap rate is so narrow. It's not worth buying. Sorry about that. It's not worth buying the C. It's not a risk-adjusted reward. So if you have an A-class property, or let's say a B, B+, it's new. It's not going to break down. There's not going to be capital expense surprises. It's going to hold its value. It's going to go up great and all that kind of stuff. Or you can come over here and buy an older C that's this affordable housing building, and you can pencil out a lot of cash flow. But if the plumbing goes and the roof goes and you got to repair this and repair that, you're not actually going to get any of that cash flow. And that's what I'm kind of saying with the prices in today's market. It's better to buy something new than something old, because the price is so high for both asset classes. Why buy an old one? You can buy a new one at pretty much the same rate of return. That's why I focus on the A's and the B's. Why I believe everybody else is focusing on the C's is because it's easier to raise money in that asset class. Why is it easier to raise money? Because you can talk about value add. That's a sales pitch that gets people investing in real estate. So my group is fine with not doing value add. They're fine with long-term hold, operate, acquisition, appreciation, tax deductions. So for our investors, that's the direction we're going, is newer buildings. But if you're new to real estate, you're probably going to be more in that C space because it's easier to raise money when you talk about value add, renovations, all that stuff. So those are some of my opinions on the subject.
Yeah, you mentioned in there that you felt like B and C apartment buildings were going to struggle. We're going to see some challenges there. C and D.
C and D. A and B, I think, will be fine. C and D.
What are you seeing happening in the market that's going to cause C class assets to struggle?
Physical obsolescence, age of building. The buildings are just getting old to where the cost basis is starting to not make sense. Cost basis, meaning what I have to buy the property for and how much money I need to put into the property, I believe in a lot of these assets is going to exceed the market value. You know, when you look at a building and you say, okay, seller, you want a 4 cap on this older 1963 built apartment complex. Okay, but I'm looking at the plumbing and that was from 1963. That's galvanized. It's mostly crumbling. It's brittle. There's leaks everywhere. And then I got to replace some roofs. And then I got some parking lots. And that 4 cap is not a 4 cap. That is a foreclosure. So you got to be extra careful about overpaying for very old buildings because the CapEx is going to start creeping up on you. And that's what I call a CapEx tsunami. And the CapEx tsunami is what I believe is going to shift the market in the affordable housing space. You know, the cost of operating those things is just starting to rise rapidly. And where you can get in trouble with these kind of buildings, and this is a little bit of a dark conversation here, but where you can kind of get in trouble with some of those buildings is if you're in a tenant-friendly city or a more liberal city. We're seeing the cities using code enforcement to really regulate these older buildings. And that's where they come in and they say, hey, you know, the property's in bad shape. You've got this, you've got that. You need to fix all these things. Well, then as the owner, we step back and say, yeah, but you know, the tenants aren't really paying rent or the rent isn't going up. And if I do all of these repairs, I won't be profitable. And the city says, yeah, not our problem. That's some other department. You go talk to them. We're code enforcement. You need to fix that. You need to do it right now, or we're going to pull your certificate of occupancy and all the tenants get to leave. And then you're going to talk about cash flow. The city does not care. They don't care whether you're profitable. They don't care whether you make money. They care about whether you take care of your tenants or not, period. And so that's what I'm kind of saying, like, hey, be careful in some of these older buildings at today's prices. I think that's not a risk-adjusted reward, and that there are a lot of people that don't understand the business. They're going to overpay for older buildings, and they're going to get caught on that CapEx treadmill. You know, you're just going to get stuck fixing stuff, not cash flowing. And that's how do I know? Because I've been there and done that. You know what I mean? I've already been down that road, and that's why I'm trying to kind of gently educate people about not price, but value and condition. And those things are very important to pay attention to. Price is irrelevant. It's how much money you're going to make. That's all anybody cares about. It's how much money we're going to make, right? And I'm kind of saying, I don't think those buildings are going to make that much more money going forward. But inflation, then there's the opposite side of that coin. Inflation should push the prices up and make me completely wrong. We'll see.
Yeah. Well, look, I appreciate you shedding some light on your thoughts about what's happening in the market, why you decided to move into the core plus space. I think that there's a lot of people that would have a differing opinion on the importance of cash flow in the deal.
I know they do.
And B and C class assets. Yeah, exactly. But hey, that's great. That's why we have you on the show, because I love hearing different opinions and new perspective. I want to start winding down here and be respectful of your time. I've got a few final questions for you. The first is, what's the biggest challenge you're facing in your business right now that we could all learn from?
Yeah, I don't know how much you could learn from it, but deal flow is tight right now. So what I would tell everyone listening, is be patient. Deal flow is tight right now. The market is tight right now. It is not like this forever. It has not been like this forever, and it will not be like this forever. So if you're relatively new to business and you haven't seen anything but this sort of up market over the last 2-3 years, it shifts, it changes. What you should be doing right now is focusing on building your relationships, getting your equity partners together, learning the business, learning deal analysis, learning all the things that you can learn, and be prepared for a new market cycle to come. If you're going to wait and you think you're going to time the market perfectly, you are wrong. What's going to happen is you're going to say, hey, I'm going to wait until the market's completely at the bottom, and then I'm going to jump into real estate. Nope. Then it's going to take you a year or two to get your momentum, and you're halfway up the next market cycle before you get, no, start right now. That way, when you go into that down cycle, you go in with full momentum. So I guess that would be the learning lesson I would want to impart to everybody right now. It's just
that's great patient. Advice.
It'll change.
Great
don't
advice.
Worry. Don't take it personally. Don't. Hey, this is the only deal you got to close. The 6 inches between your ears. That's the only real estate deal you ever have to close. If you close that one, everything else take care of itself.
Great advice. What's something that you're absolutely crushing right now that we, in your business, that we could all learn from?
I would say networking right now, networking, money raising, things like that, which is a large function of why I've written these books and why I put in, educational content out there. One, I like teaching. I enjoy it. It's a personal fulfillment. Two, I want the information out there because I know it helps people. But let me be real clear. Nobody's getting rich selling books, not unless you're, Stephen King, a New York Times bestseller, something like that. It's a 200-page business card. And so that these books and doing podcasts and things of this nature are sort of a marketing outreach. And so that's what I'm kind of doing, what I'm telling everyone else to do. If the market is slow and deal flow is slow, don't quit, don't get distracted, find something else of value to focus on. So since I'm not closing a whole lot of deals right now, and I've sold a few, I'm now focusing on the next market cycle. So I'm networking, I'm getting my name out there, get the books out there, all those different things. So yeah, that's what I would recommend everybody do, is try and follow suit and really build your relationship. So that's what I would have to say we're crushing it at.
Well, that's a great note to wind down the show on. What's the best way for our listeners to learn more about you and what you have going on in your books and get a hold of any of the content that you're putting out there?
Yeah. First of all, the two books are Creative Cash and the other one is Real Estate Raw, and both are on Amazon right now. So you can go to Amazon and just type in my name or Real Estate Raw, Creative Cash, pull right up. We have those. I have a website by the name of the book, realestateraw.com. So if anybody, I have a free video course there and some other material. If anybody wants any more stuff to learn, you can go there. And if anybody wants to reach out to me directly, it's bill.ham@bpgmail.com. Or actually, let me give you an even easier. I forget, I have some emails. Bill@gobroadwell.com. That's much easier. Let's go that way. Bill, BILL, @gobroadwell.com, BROADWELL. Hey, yeah, comments, likes, comments, concerns, please send me an email. If you completely disagree with everything I said, I'd love to debate you, love to talk to you about it. So please send me an email. But that's how everybody can reach out to me. And I'm here to help. If anybody needs anything, just let me know.
Awesome. Well, Bill, this has been a great conversation. I've really enjoyed it. Thanks for sharing your journey with us and some of the insights that you have around what's happening in the market and what you see happening in the future and sort of your focus and investing thesis. That's very helpful to our listeners. And I look forward to connecting with you down the road. I appreciate you coming on.
David, I appreciate it. Thanks for having me on.